Sasol was founded in 1950 to make oil from coal, that for the South African market, as the country had no significant crude reserves. Today, Sasol uses coal, oil and gas reserves to manufacture and sell liquid fuels, fuel components and chemicals throughout the world. Sasol has a market cap of 230 billion rand, a PE of 8 and a dividend yield of 4.4%. The alternative in this case would be the Standard Bank oil exchange traded note. Now, do I even have to go into this conversation with the two of you? Of course, you love Sasol. Tell us why you love Sasol, Paul.
Yeah, just once again, all the global diversification, it's moved up quite nicely recently. Obviously, the oil market's a little bit flighty at the moment. People are a little bit anxious about China and so on and so forth. But remember, Sasol is moving its operations to the Northern Hemisphere and to the North American market in particular, where I think there's great scope for their gas to liquids technology. So love that one.
Love it. Gary, before we move on, let's do Sasol and then we'll go to the oil exchange traded note.
Yeah, also you gotta love Sasol. Like, I mean,
exactly. Who doesn't love Sasol?
With the oil price sort of retracing back up to the that $120 a barrel mark, I mean, Sasol's taking full advantage of that. It's I mean, if you could get in at about 336 when it turned, you'd be smiling about now.
But where's the real kicker for Sasol going to come from?
Well, at some point it needs to diversify its substantial profit dependency on the South African market. So it's got its plant in Qatar, it's got some projects under development in other parts of the world, but it's still seen by the international market as an African energy story. And it gets a little bit of a discount because we know oil and petroleum products are a tightly regulated market. Our market for liquid fuels is regulated, so that makes people slightly uneasy. That's the real challenge. That's why it's only on a PE of 8. I mean, we might as well all stand here and say we all love it, but if we all loved it enough, it would be at a higher PE than that.
My point exactly. All right, so the exchange traded oil, or the oil exchange traded note.
Yeah, it's a very similar story to also done by Standard Bank. So I mean, you also obviously, like Paul said, taking on Standard Bank's risk, where when you're investing in the product, I think they're sitting at AA negative though. So it's not necessarily.
It's not like
we're not talking Greece.
We're not talking junk bond status or anything like that. I think it's a fair risk to assume.
Yeah, I mean, I think if Standard Bank goes out of business, we've got bigger things to worry about than our little bit in our exchange traded notes. But looking at it, again, it's going to take full advantage of the oil price, but again, I have to point on this one. You've got the Quanto future out there that you can strip out all the currency risk, get a little bit of gearing with it as well, and take full advantage of an oil price move without having to worry about the rand component.
Just one other thing that worries me slightly about these futures-based front-month traded futures contracts is the way it works is that they take that and then they roll it from one month to the next. There have been instances in global markets where things have gotten very choppy, where there's a big gap when they roll them. So there's that roll risk. And sometimes even Goldman Sachs, which is a commodity index that was tracking the oil market, suddenly found big price variations opening up in the value of the ETF because they'd got some kind of a bum roll from the one to the other. And they said, well, look, there was someone else busy messing with the markets when we had to do it. So understand that you do get tracking error, specifically over time. Look, it doesn't matter if you buy it today in anticipation of some OPEC meeting next week.
But what, when you say you buy it with a 5-year view?
Exactly. You can't say, okay, well, I'm going to buy this thing now, and then in 5 years' time I'll look again, and if oil's gone up, this thing will have gone up by the same amount.
Is that a fair comment from Paul?
I think it's completely fair. I mean, Standard Bank, they do their rolls. I think it's about a month before expiry, but which gives them some space to ride it out if there is a discrepancy in the market. But looking at it, I mean, I think we also need to differentiate that the exchange traded notes, they're trading products. You're taking a view on a movement on the price. You're saying, I think oil is too low. Let's buy this because oil will increase. Whereas for a long-term investor, if you're looking 5-10 years, the company will always outperform because, like Paul says, they're producing a product and selling it for a margin. And there, I think, lies the difference.
I have to ask you, although I know the answer, hot or not on Sasol, Mr.
Oh, what a beauty. It's so hot.
And Gary, hot or not on Sasol?
Got to go hot too.